Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the industrial base of the AI economy, the Magnificent Seven, and the MAGS ETF.
And, calling them the industrial base isn't even hyperbole anymore. It is January 19, 2026, and the ground has really shifted.
It really has. I remember just a few years ago, we talked about these companies, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla, as the fun part of a portfolio.
Yeah, the growth stocks.
Exactly. High-growth tech stocks you bought because, you like their phones or their apps. But looking at the research you brought in today, that definition feels almost, quaint.
It is quaint.
Yeah.
We really have to stop thinking of them as just tech stocks. These 7 companies have become the literal infrastructure of the entire global economy. Their combined valuation is, what is it now? Sitting at $21.68 trillion.
21 trillion. It's a number so big it just sounds fake.
It breaks the brain a little bit. For context, that's larger than the GDP of most continents. But that valuation isn't even the wildest number I found in the data.
Oh.
The number that explains everything that's happening right now is $527 billion.
And that's the spending, right? The CapEx.
That is the projected AI capital expenditure for 2026 alone. These companies are self-funding an industrial revolution with their own cash. And that, right there, sets up the whole conflict for this deep dive. Is that $21 trillion valuation a real, solid economic engine? Or is it a fragile bubble fueled by what some analysts are calling circular financing?
And that's the question. That's what's keeping people up at night. So to navigate this without getting lost in, 7 different balance sheets, we're going to look at the specific vessel a lot of people are using to play this theme, the MAGS ETF.
The Roundhill Magnificent 7 ETF, ticker MAGS.
Okay, so let's pop the hood. On the surface, it seems incredibly straightforward. It's an ETF. It holds the 7 companies we just listed. As of early 2026, it's managing about $4 billion in assets. But I want to challenge you on the why.
Go for it.
The expense ratio is 0.29%.
Mm-hmm.
So if I put in $10,000, I'm paying, what, $29 a year?
$29.
Yep, which, it's not expensive, but it's not free. Why shouldn't I just open my brokerage app, buy some Apple, some Nvidia, and, save the $29?
You absolutely could. But you'd probably mess up the weighting. The secret sauce of MAGS isn't the stocks it holds. It's the equal weight strategy.
Explain that. Because normally if I buy an S&P 500 fund, I'm owning more of the biggest companies.
Exactly. The S&P is market cap weighted. So if Nvidia has a monster year and doubles, it starts to take up this huge, huge chunk of the index. You accidentally end up doubling down on the winner after it has already won.
So if Nvidia sneezes, my whole portfolio gets the flu.
Your whole portfolio gets the flu. Standard indexing makes you chase performance. MAGS does the opposite. It holds all 7 companies in roughly equal amounts. But the key is the quarterly rebalance. So imagine Nvidia goes on another one of its parabolic runs. It's up, say, 40% in the quarter, while Tesla is just flat.
Okay, so I'd be feeling pretty good about my Nvidia holding.
Well, you would, but the ETF discipline kicks in. At the end of that quarter, the fund mechanically sells that extra Nvidia profit. It sells high.
Right.
And it uses that cash to buy more Tesla, or whichever stock is lagging. It buys low.
That feels, emotionally, that's tough. You're cutting your flowers to water the weeds.
It's incredibly difficult. That's why individual investors are so bad at it. We fall in love with our winners. We think Nvidia's going to the moon. Why on earth would I sell any of it?
Yeah.
But this mechanism forces you to mitigate risk. It makes sure your portfolio never gets dangerously concentrated in just one stock.
But there's a trade-off there, isn't there? If I'm always selling the winner, I'm capping my own upside.
You are, 100%. If Nvidia is the only stock that moves, and the other 6 are dead money, MAGS is going to underperform just holding Nvidia. That's the deal. You get diversification that lets you sleep at night, but you give up some of that moonshot potential of being all in on the leader.
Okay, so that's the vessel. Now the ocean it's sailing in. That $527 billion CapEx number, Goldman Sachs is calling it the AI spending supercycle.
It's historic. We haven't seen this kind of capital injection since, the internet build out in the late 90s, maybe the railways. But the dynamic here is so unique because of what's called the closed-loop economy.
This was the part of the research that made me first laugh and then get a little worried. It feels like a poker game where the same 7 people are just passing the same stack of chips around and around the table.
That's not far off. Think about who's spending the money and who's getting it. You've got the builders, Microsoft, Meta, Google, they're spending tens of billions building massive data centers, locking down energy contracts, laying fiber.
And all those data centers need chips.
Exactly. So they turn around and write a check to the seller, Nvidia.
Yeah.
Nvidia sells them the new H200s. So Microsoft's expense becomes Nvidia's revenue,
It's a very neat, tight little circle.
and it gets tighter. Because to justify all that spending, Microsoft has to show it's making money from it. So they push the SaaS layer software as a service. They're baking AI into everything. Copilot is the big one.
Right.
They're now reporting over 100 million monthly active users across their commercial and consumer lines.
Wow, okay. 100 million is a massive number. That's not just hype.
No, that's legitimate adoption. It shows that revenue is at least trying to catch up to the infrastructure spend. They aren't just building empty digital warehouses. People are actually paying to use the software that runs inside them.
But is the revenue catching up fast enough? Which brings us to valuation. This is where the bulls and the bears are, they're living on completely different planets.
It is a tale of two spreadsheets, for sure. If you take the bull case, the valuation actually looks surprisingly rational.
Rational is not a word I generally associate with a $21 trillion price tag.
No, I get it, but bear with me. The MAGS 7, they're only about 1% of the companies in the S&P 500.
Right, just 7 of them.
But they generate 37% of the profits. They are unbelievable cash machines. We're talking something like $747 billion in annual cash flow. Their median forward PE, price to earnings, is around 30.
And 30 is high, but it's not, dot-com bubble high.
That is the argument. In 1999, you had companies with no profits trading at 100 times earnings. Here you have 30 times earnings for companies that literally own the global digital infrastructure. The bulls say that's a fair price.
Okay, so that's the brochure version. But you dug into the bear case, and you found a number that just stopped me cold. You said the true multiple isn't 30x, it's 77.
77.
Wait, hold on, 77? How? How is that even possible? You're saying the real price is almost triple what my brokerage app is telling me.
It's all about what you count as a cost. The standard PE ratio, the bears argue, is misleading because it ignores two huge drains on shareholder value: capital expenditures and stock-based compensation, or SBC.
Okay, let's break that down. Stock-based comp, that's when they pay employees with stock options instead of just cash.
Exactly. And in tech, it's a massive expense. Think of it like this. You're a landlord. Instead of paying you rent in cash, your tenant pays you in lottery tickets. It doesn't cost the tenant any cash today. But if those tickets win, if the stock price soars, the value of your ownership gets diluted. You own a smaller piece of the pie because they just printed more pie to pay the employees.
So it's a real cost, it just doesn't show up on the cash flow statement in the same way.
It's often treated as a non-cash expense, so analysts just ignore it. But it's real dilution. And when you combine that with CapEx running at 14% of sales, that's money flying out the door for concrete and chips, the actual earnings yield left for you, the shareholder, is tiny.
How tiny?
The free cash flow yield is probably less than 1%.
Ouch. So I'm buying this huge company, and after they pay their engineers in stock and buy all their chips, there's less than a penny of actual profit left for every dollar I invest.
That's the bear case in a nutshell. You are paying a massive premium 77x for growth that hasn't materialized yet. And if that growth slows down even a little, the stock price has a long, long way to fall.
And speaking of growth, that might not be real. Circular financing. This sounds like a term invented by a lawyer to avoid saying something else. What is it?
Well, it's legally distinct from a Ponzi scheme, but the mechanics can feel uncomfortable. It's this fear of round-tripping revenue. Here's how it works. A tech giant, let's say Google, invests $1 billion into an AI startup, like OpenAI or CoreWeave.
Okay, so cash leaves Google, goes to the startup.
Right. But what does that startup do with $1 billion? They don't just sit on it. They turn around and use that exact same money to buy cloud services or chips back from the very giant that just invested in them.
Wait a minute, so I give you $1 for your lemonade stand. You immediately take my dollar and buy a lemon from me. I get to book that lemon sale as revenue and tell Wall Street I'm killing it, but I just got my own money back.
And you still own a piece of the lemonade stand, which you now value higher because its sales are through the roof. It creates this illusion of organic demand.
It feels like a shell game. Is any new money actually being made here?
That is the $500 billion question.
Goldman Sachs estimates that this circular loop could account for as much as 15% of Nvidia's sales.
15%. That's not a rounding error. That's a structural pillar of their business.
It is. And the risk is that if the venture capital dries up, if the giants stop writing those checks, that 15% of revenue just vanishes. It's not a slowdown. A chunk of their market just ceases to exist overnight.
Fascinating and terrifying. Now, I want to go back to the MAGS ETF itself for a second. We talked about the stocks, but you mentioned something about the fund structure, something most people probably gloss over: synthetic exposure. Yeah, this is buried deep in the prospectus. NGS doesn't just hold physical shares of all 7 companies. It uses what are called swap agreements and forward contracts for about 62% of its portfolio.
Swap agreements, forwards. Okay, that sounds complicated. Why not just buy the stock?
It's about efficiency. Remember that quarterly rebalancing. If they had to physically sell Nvidia stock every time it popped, they'd be triggering taxable events and transaction costs constantly. A swap is basically a contract with a bank where the bank agrees to pay the fund the return of the stock.
So instead of owning the car, I have a contract with a guy who promises to pay me whatever the car's value changes by.
That's a pretty good analogy, but it introduces a new risk: counterparty risk.
The guy might go broke.
The guy might go broke. Exactly. You're betting that the financial institution on the other side of that trade, usually a huge bank, will actually pay up. If we hit another 2008-style crisis where banks start to fail, the fund could lose money even if Apple and Microsoft are doing great.
So by buying this ETF, I'm adding a layer of banking risk on top of my tech risk.
It's a remote risk. These are major institutions, but yes, it is a real structural difference from just owning the shares yourself.
I think that's a really crucial point. You're buying a derivative structure, not just a basket of stocks.
Okay, let's zoom out. We're in 2026. The economy is acting very strange. How are these 7 companies affecting the bigger picture, specifically with the Fed?
They've essentially broken the transmission mechanism of monetary policy.
Okay, break that down. Usually the Fed raises rates, borrowing gets expensive, companies slow down, inflation cools off.
That works for you and me, and for a normal company that needs a loan to build a new factory. But remember that war chest: $747 billion a year in cash flow. The Magnificent Seven do not need to borrow money.
They're their own banks.
They're basically sovereign economic states. So when the Fed jacks up rates to cool down the economy, these 7 companies barely even feel it. They just keep spending, keep hiring, keep building. It's created this 2-speed economy. You have the AI industrial base in hyperdrive, while the rest of the economy is choking on high interest rates. Which explains why the market keeps going up, even when Main Street feels shaky. Okay, let's talk about the human cost. AI is coming for your job. That's the headline we've seen for 3 years straight. Is it finally happening in the data?
This is where the narrative and the actual data completely diverge. If you just read the headlines, you'd think robots are walking people out of the office by the thousands. But the analysis from 2025 shows that AI was cited for only 4.5% of job losses.
4.5%. That seems incredibly low. I feel like every single layoff announcement I read mentions a strategic pivot to AI.
That's the key phrase right there: strategic pivot. The reality seems to be that a lot of companies are using AI restructuring as a convenient mask.
Masked for what?
For fixing their own hiring mistakes. A lot of these tech companies went on a hiring binge during the pandemic and just got way overextended. If you fire 10,000 people because you messed up your headcount, Wall Street punishes you. It looks like bad management.
But if you fire them and blame AI...
If you fire 10,000 people and say, we are restructuring to leverage our AI capabilities, your stock price actually goes up. It makes you sound innovative, efficient, forward-looking.
That's incredibly cynical. So we're seeing cyclical layoffs, just bad planning, being dressed up as technological progress.
For the most part, yes. It's a brilliant PR strategy. The actual displacement, where an AI tool literally replaces a person's entire role, that is happening, but it's a slow creep, not the tsunami that the press releases suggest.
Wow. So we've got a market fueled by circular financing, valuations that might be triple what they appear, and a labor narrative that's half fiction. If I'm listening to this in January 2026, trying to figure out what to do with MAGS or these stocks, what's the verdict?
If you put it all together, MAGS is a very specific tool for a specific job. It's great for what I'd call the diversified believer. Someone who is convinced this AI infrastructure build-out is real and transformational, but is terrified of picking the wrong winner. You don't know if it's going to be Google or Microsoft in the cloud war, so you just buy both.
It protects you from being on the wrong side of that one specific bet.
But you have to accept that cap on your upside. You will almost certainly underperform the single best stock in the group.
So what's the canary in the coal mine? What should we be watching for right now?
It's all about the monetization pivot. We are heading into the Q4 2025 earnings reports over the next few weeks. You need to listen for one specific phrase: spending moderation.
Which sounds good, like being responsible, but you're saying that's dangerous.
In this context, it's deadly. If Microsoft or Google comes out and says, we're going to moderate our AI CapEx this year, the market will panic. It's a signal that the demand isn't there to justify building the next data center. If the spending stops, Nvidia's revenue falls off a cliff, and that whole circular financing loop starts to unravel.
The entire thesis relies on them just continuing to spend more and more money forever.
Or at least until the profits can catch up to the spending. The whole group is still forecasted to deliver, 23% earnings growth in 2026? The entire valuation, whether it's 30x or 77x, it all relies on them hitting that number perfectly.
So no misses. Perfection is priced in.
Absolute perfection.
Well, this has been a massive deep dive. We've gone from the mechanics of an ETF to the hidden risks of circular financing and synthetic swaps. To sum it up, the Magnificent Seven are funding a $500 billion revolution with their own cash. But the true price might be astronomically higher than it looks on paper, and there are structural risks that could cause a cascade if that growth narrative even cracks.
That is the summary. It is high risk, high reward on a scale we've just never seen before.
Before we let you go, leave us with one final thought, something for people to chew on after this is over.
We focused a lot today on the financial bubble, the stock prices, the PE ratios. But I want you to consider the technological bubble. If these companies are spending $527 billion a year on AI infrastructure, on chips, on data centers, on power plants, and the revenue doesn't show up by the end of this year, 2026, we won't just see a stock correction. We might be looking at the most expensive collection of empty factories in human history. Is the AI demand real, or is it just the Magnificent Seven selling shovels to each other in a circle?
That is a haunting image. The world's most expensive ghost towns made of silicon and servers. Thanks for listening to The Deep Dive.